Good morning, good afternoon, where you might be. My name is John Keenan. I'm a principal of BRI Ferrier, and with me here today is Peter Krejci, one of my co-principals here, and we have the pleasure of having a chat today with Stephen Koukoulas, otherwise known as the Kook. Stephen is the MD of Market Economics, a leading Australian economist, and some of his videos you may have seen online are very interactive and engaging. He's a former advisor to the Julia Gillard government and the former chief economist to Citibank. Stephen, welcome.
Thank you very much.
Excellent.
Stephen, 50 basis points yesterday. Not many economists call that. It is a significant interest rate hike. Is it fair to say that the economy is delicately poised? We've got rising energy costs, we've got inflation seemingly out of control. We have the RBA somewhat behind the eight ball, wage pressure, all these added costs. How do you see the economy at the moment?
Yeah, well, the fact that the RBA went so hard with that 50-point rate hike and following the 25-point move the prior month, so we've had two in a row of pretty chunky rate hikes, says to me that they are genuinely concerned about the inflation pressures coming through the economy. Sure, some of them are supply chain related, but you've got to remember too that we've recently seen the domestic side of the economy doing pretty well, that consumers are still spending, so the retail sales numbers are strong. The unemployment rate is wonderfully low, under 4% for the first time since 1974. So I think the RBA is looking at the economy, seeing that it's in pretty good shape, and that the incredibly low interest rates that were put in place when we had the COVID pandemic are no longer appropriate. And they've indicated that there's more rate hikes to come. They're going to keep moving rates higher until they squeeze inflation back towards their target range of 2 to 3%.
Well, that's the magic question, I think, Stephen. So looking forward over this coming year, if you would, what's your views on the magic number where interest might get to along with the inflation? Do you have a view there?
Yeah, I sure do. And look, the interesting thing for me, and again, the RBA made this very clear in their statement, is that there are more rate hikes to come, and we economists are debating when, how many, when they're going to occur, and those sorts of things. But I think it's fair to say, when we look globally as well, what's happening in the US and Canada, UK, New Zealand, for example, that they've got rate hikes coming. They're moving rates pretty quickly towards that 2.5%, maybe even 3%. And I think that's the sort of rate scenario that we're going to see in Australia over the next 12 months. So I think for the next couple of months, we'll see the RBA moving rates relatively quickly up to that 1.5%, maybe 1.75 level or thereabouts. They may pause for a month or two just to see the impact that that's going to have on the housing market, on consumers, and even on the business sector as well. And then if the inflation rate's still very elevated and the unemployment rate's still very low, they'll keep going. So in my view, we're probably going to see the official interest rates head to about 3, maybe 3.25% by the middle of 2023.
Yeah. I'm interested to know what does it mean for the housing market and the equities market? Because as you know, we've had 10 years of ultra low monetary policy. There has been inflation, and that's manifested itself, I think, in the housing market, in the equities market, and ultimately it's ended up in consumer prices. So is that genie out of the bottle, and how do you get it back in, and what does it mean for housing and equities?
Well, housing and equities are both sort of big asset classes, and they don't like higher interest rates. I think that's the sort of rule of thumb that we can start with. And already we're seeing house prices, certainly in Sydney and Melbourne, they've actually fallen a little bit. Nothing to be too worried about at this stage, but the rate of growth of house prices in Adelaide, Hobart, Brisbane, where there is still some residual strength, they've certainly come off the boil as well. And when I look at the equity market, it's basically tracked sideways to slightly lower for the last few months. And I think that probably continues as the RBA and the Federal Reserve and other central banks continue to hike interest rates. So I'm not mega gloomy on equities or housing for that matter, because I think the labour market in Australia is pretty strong and consumers will be somewhat resilient in the face of these higher interest rates. But that said, it's very hard for example, house prices to keep growing the way they have been over the last 18 months. And we'll probably see house prices correct somewhere between 5 and 7%. Some cities will be different to others. We may see 10% drops in Sydney and Melbourne, which of course have had the very big increases. And for share prices, again, the higher the interest rate cycle goes, the more gloomy you would be on share prices. But at this stage, if we do get that cash rate to 3%, we're probably going to have an orderly sort of move in the stock market, probably goes sideways to slightly down, And the next leg up will be, goodness me, whenever we get that next rate cutting cycle, which is probably a couple of years away.
We certainly we recognise the cash reserves out there at the moment are certainly going to be able to absorb some of that movement. But in the business sector, which we see closely on a day-to-day basis, we are seeing increased activity from companies facing some distress, with ATO debts at record levels, and the ATO now finally starting to act, and some might say trying to do some budget repair for the new incoming government. What we're seeing is that certain segments, as you probably have seen, Stephen, like construction, retail, actually even some of the electricity manufacturers or suppliers, I should say, in that sector, they're really facing some tough challenges ahead. And that's leading to some restructuring that's having to go on. I don't know what you've seen in that regard, but
look, I think you're right. And in fact, construction is one of the sort of high-profile ones where there's the supply chain problems are hitting them very, very hard, because they're often operating under fixed-price contracts, and the cost of timber, the cost of steel, the cost of all the bits and pieces that go into the construction side of the economy have increased markedly, and there still are, and again, there's supply chain problems with shortages even occurring. So they're slow to finish the jobs, not of their own fault, but because of these supply chain problems. So I think that there's a squeeze coming in certain sectors, again, because of these issues being more acute in construction and retail, as you alluded to, that it's hard to find staff. There's labour shortage is very, very acute right now. And if you can't find staff, you can't open your doors. And that's what's happening in some of those retail pockets as well. But that said, I think we've still got the economy that's doing reasonably well. You made a very good point about the new government and the tax office. You know, we do know that the new Treasurer, Jim Chalmers, is hunting around the budget for anything that can help reduce this budget deficit and government debt. They're both genuine concerns for the government, and I think they are a bit of a problem. It'd be nice to have a lower budget deficit. So I dare say he wouldn't be at all unhappy with the tax office cracking down on people who owe tax. And of course, that's, while it might be good for the budget, it actually puts a lot of pressure on the business sector if you've got to stump up a big chunky tax payment because the tax office is coming after you.
Absolutely, and we're seeing that in the form now where people are needing to engage in some balance sheet repair of their own. And that's usually by way of some of the options we have through the voluntary administration, the deed of company arrangement, or the safe harbour measures. Because now there is no more government support. The relief they had, that's gone.
Oh, and very much so. Yeah, well, we think back to the JobKeeper payments, and also the other, well, speaking of the construction sector, you know, on housing anyway, there were some very, very generous measures to try to get people to spend money on renovations, on building new housing. And that was important. Don't get me wrong. I think both of those policies were generally good when we were in the middle of the COVID pandemic, but they have ended. So that lifeline, I suppose, that was out there for the business sector, and the lifeline of your very, very low interest rates have both come to an end. And so that pressure on costs, that pressure on your business is still very much there. And again, we mentioned supply chain problems a moment ago. They are still very real. There's some evidence that say some of the shipping rates are coming off, and the chips are being a little more available to car manufacturers and electronics goods and these sorts of things. But it's going to take probably 6 to 12 to 18 months before they fully recover. So if you're relying on those things as inputs to your business, you're still going to be confronting a major problem when trying to just keep your doors open.
Look, there's little doubt that businesses will feel the pressure. As we mentioned earlier, you've got the wages pressure, you've got the energy costs, you've got the general sentiment. I think it would be weighing on people. We've had that wealth effect with rising property prices. Now that's coming off, and I think businesses will need to look at their balance sheet and perhaps look at restructuring and going through a process at this point in time may be something they need to consider. Otherwise, hopefully they've got the wherewithal to deal with what's going to be a pretty rocky period in our view.
Well, I think just in summary, I guess what we're seeing now, we haven't seen for 30 or 40 or 50 years. Now, I've got a bit of grey hair. I've been around a long time, but we haven't had inflation this high for 30 years. We haven't had unemployment this low for 50 years. The interest rate hiking cycle we've seen started in the last 2 months is the first hiking cycle in 11 years. So all of these things are coming together. And if you're a business operator and you're experiencing high inflation, skill shortages, a significant increase in your wage costs and rising interest rates for the first time in 11 or 12 years, it's a challenging environment out there.
Absolutely. Well, Stephen, I think that about covers what we wanted to talk to you about. It's been terrific. You've given us a terrific insight in the mind of an economist and the sort of issues that are out there in the economy. I'd hate to be in Jim Chalmers' shoes. It's a challenging assignment. I think he's realising what the previous government had kept, out of the public arena, and he has to deal with it. But I'm sure he's up to the task. But thank you so much for the talk today. Really appreciate
Thanks
it.
for the opportunity to chat to you, and all the very best for the remainder of 2022 and into 23.
Thanks, Stephen. Cheers.
Thank you.